To the untrained eye, financial markets look a lot like a casino. You see a jagged line flickering on a screen, violently spiking 1 second and crashing the next, driven by forces that seem entirely unpredictable. For someone known as a trader, this chaos is the whole point. They attempt to profit off these rapid, short-term price movements, capturing a quick spread between a buy and a sell price, without worrying about what the underlying company actually does. True investing operates on an entirely different timeline. It requires committing your capital upfront, backed by rigorous business analysis, to earn sustained growth over decades. While a trader places bets on the immediate psychological reactions of other players in the market, an investor is evaluating the concrete, long-term reality of a functioning business. That distinction matters because the stock market has a built-in complication. It is made up of human beings acting in large groups. Behavioral finance studies exactly this problem. It shows how herd mentality and common cognitive biases regularly warp market activity, causing people to act irrationally rather than maximizing their wealth. This chart shows how those human biases create a massive, measurable disconnect. The steady upward line represents a company's intrinsic value, its actual worth based on the cash it generates. The chaotic, jagged line weaving around it is the current market price. Notice the wide gaps between the two. When the crowd gives in to fear, panic drives the market price far below what the business is actually worth. And when euphoria takes over, the price shoots dangerously above that baseline. Since the daily market price is often an emotional illusion, you need a reliable compass to uncover the true value hidden underneath. That compass is fundamental research. To figure out a company's true value, analysts have to gather information. But there is a strict, non-negotiable legal boundary. They cannot use insider, non-public material information, secrets that aren't available to the general public. Instead, they rely on a legal methodology known as mosaic analysis. Like building a picture from scattered tiles, they gather tiny, seemingly mundane pieces of public data from dozens of different sources. An analyst reviews an economic report, a public filing there, and a minor supplier's press release. Individually, these details mean little, but pieced together, they form a highly accurate proprietary insight into the company's health. Professional research is rarely about uncovering a hidden secret. It is about being the most thorough detective in the room with the information everyone else already has. To analyze that information, the financial industry uses three main tools. The first is technical analysis. Technicians, or chartists, operate on the core assumption that price discounts everything. They believe all known information is already baked into the stock's current price. Because of this, they ignore the company's business model entirely. They study historical patterns in trading volume and price momentum to forecast short-term direction, embracing the market noise instead of trying to fight it. For long-term investing, you need the second tool, fundamental analysis. This is the deep dive required to cut straight through that daily noise and locate true intrinsic value. This NISM syllabus table breaks down fundamental research. Notice the three highlighted rows: economic, industry, and company analysis. Studying these interconnected baskets helps project a company's future cash generation. Notice the heavy weightage placed on these core subjects. Some analysts also employ a third method, quantitative research. This approach uses pure historical data, regressions, and econometrics, applying heavy math to smooth out market fluctuations. But it has a major limitation. Accounting standards shift constantly, and business models evolve. Relying purely on mathematical formulas from past data often makes for a highly unreliable predictor of tomorrow's market conditions. Charts track the momentum of the crowd, and math provides historical context, but fundamental analysis alone reveals the actual long-term value of a business. This brings us to the active investor. These individuals synthesize the hard data of fundamental analysis with a sharp understanding of behavioral market psychology. This diagram illustrates their primary objective. They constantly evaluate their portfolio to locate the specific gaps where the market price is out of alignment with the intrinsic value. You can see undervalued assets illuminated in green and overvalued assets in red. Once they spot those gaps, they execute. They buy up the undervalued green assets and sell off the overvalued red ones,
locking in their positions before the rest of the market corrects its emotional mistakes. Not everyone chooses to play this intensive game. Passive investing is a popular alternative for those who skip rigorous individual stock research entirely. Instead, passive investors simply buy a broad basket of stocks to capture the average return of the entire asset class over time. But if you do choose to actively engage with the market, remember the distinction between the screen and the reality. In an environment driven by short-term speculation, the price is merely what you pay. Deep, methodical research dictates what you actually get.